Thank you for coming this morning. It's great to have quite a crowd, and it's great to be back working with Euromoney, and my thanks to the sponsors, Commercial Bank and others who are part of this. So today I'm going to talk to you about this journey that we've all been on with digitization and talk to you about Bank 4.0. But before I get to Bank 4.0, I probably should give you guys a bit of a primer on Bank 1.0, 2.0, and 3.0, right? So we can get you there. So obviously banking is a very traditional space, and the oldest bank in the world, which is Monte dei Paschi, it's in Siena in Italy, is about, over 500 years old. And you can see they were founded in 1472. That was just 8 years after the death of Cosimo Medici. And if you've heard of the Medici Bank, the Medici bankers were the founding fathers of modern-day banking, really. And so just 8 years after Cosimo Medici died, and the oldest bank in the world is still alive from that time. A lot of the language we use in banking today comes from these old days. You know, the word bank actually comes from the Italian word banco. And the bancos were the bench sitters in the marketplace, because banco literally means a marble bench in the Italian marketplaces. So in Verona, in Siena, in Firenze, they would go and they would sit in the marketplace, and they'd have their corner of the marketplace where the traders would come, and the bankers would change the money, they would offer credit, things like this. But sometimes, just like in the financial crisis, the banks got into trouble. Monte dei Paschi's been bailed out a couple of times. But what they would do is, if the banks got into trouble, they didn't have the central bank to bail them out back in those days, and so the people would make sure they wouldn't come back again. They would smash the bench up. And so the Italian word for this is rapcia, ratu, to pull apart, break apart. So you get banco rapcia. The banker was bankrupt. Okay? So a lot of the language we use for banking hasn't changed in hundreds of years. We talk about mortgages. Mortgages actually comes from the French, mortgage, which comes from the Latin, vadium mortem, which was a legal construct Sir Thomas Littleton put in place in the 12th century for common folk to own land. Vadium mortem stands for the dead pledge. I don't know why we call mortgages the dead pledge. Maybe it's because you only get to pay off your home just before you die. I don't know. But so a lot of the language we use from these days goes back hundreds of years. And so when you think about changing or disrupting banking, a lot of bankers are a little skeptical because it's been hundreds of years and it really hasn't changed that much from that basic distribution model of branch-based banking. In the 1950s, we started to introduce technology into banking for the first time. Banks were at the forefront of a number of uses of technology, particularly in respect to mainframe computer technology. This is the first bank mainframe. It was built in 1953 for Bank of America. Not for Commercial Bank. You guys didn't have a mainframe in 1953, right? And so this was built by the Stanford Research Institute. Have you heard of Stanford Research Institute? How many of you have an iPhone or have used Siri? Siri is voice recognition technology, simplistic voice AI built by Stanford Research Institute. So they've been in this technology game for a long time. So the first bank mainframe was called IRMA, Electronic Recording Machine for Accounting. This is where acronyms come from in banking, apparently, as well. But you'll notice on your left-hand side what looks like sort of a row of ice cream containers or something. This is actually, these were card readers for electronic checks, for processing checks, rather. They would read the magnetic ink on the checks and process this into the general ledger. And in doing so, every customer, had to have a record on the ledger. So because prior to mainframe, you'd actually walk into a bank branch and they would write your balance on a card inside the branch, and they would do the same in your passbook, and that's how your balance was kept. It was just kept on an index card in the bank branch. But when we put it on mainframe computers, we had to automate that. And so we had to sort all of the customer records and be able to put into their ledger a deposit from a check into a customer's record. But IRMA wasn't a very sophisticated computer. Your smartphone today has millions of times the processing power of this mainframe. And so the customer records needed to be sorted numerically. We couldn't sort by name or address or anything like that. So every customer was given a unique identifier, a unique number. And this is the first recorded use of bank account numbers in the world. So you want to know where bank account numbers came from? They came from implementing mainframe computing technology. In the 1980s, we started to look at self-service automation of banking. So this was the Bank 2.0 era. So we started with telephone banking, then ATM banking, and then we get to internet banking in the mid-90s. Now, the design principles here were essentially, we were trying to extend the operating hours of the bank branch. So from a design influence, everything was built around the way we thought about operations of a bank based on bank branches. So the ATM was an automated teller machine based on the function of a teller in a bank branch. Telephone banking would give you access to the same sort of functions you get in the bank branch. When internet came along, what did we do? Well, Amazon and these other companies were starting to build commerce online, e-commerce. You could buy goods and services, initially buying books, and then you could buy retail goods and so forth. But banks were like, no, we don't want to do that because we got the bank branch for selling to customers. But we have to do something on the internet. What can we put on the internet? And someone says, we could put bank statements online. And so version 1 of internet was literally you could log in and you could see your bank statement. It wasn't very, from a design perspective, particularly innovative. It was an iteration on the existing model. Then mobile banking comes along. The smartphone, what do? Great, we can put our bank statements on a small screen now. You know, this was how we thought about innovation. It wasn't that we were changing the industry. We were simply taking the bank branch model and fitting it onto these new technology channels as they emerged. So this is not innovation per se. This is iteration based on the branch model, just simply tacking on new channels. But then things did start to change when the smartphone came along, because we started to realize we could do things on a smartphone that we could never have done in a bank branch. For example, I could give you your balance in real time before a transaction and after a transaction. I could use one-click strategies and things like this. I could start to design your interactions based on this sort of real-time relationship with your money. So for the first time, we started to see emerging mobile challenger banks. The first mobile challenger bank in the world, of course, was Movin, which we started in New York back in 2010. We were the first bank in the world to offer online account opening in a mobile app. We were the first bank in the world to offer an instant receipt for a transaction when you went into a store, which you could get coming up on the smartphone even before the point of sale was printing off a piece of paper. And we introduced a concept for the homepage, which was different from most banks at the time, where banks would have a list of accounts. You'd log into your banking app, and it would show you checking account, savings account, credit card. Instead, we put on the homepage what we called our spending meter, which would show you your relationship with the money. If you're spending above your typical spending for the month, the whole app would turn red, like this. If you're spending below your typical spending, it would be green. So this visual indicator of your financial health was something that was a completely new concept or design for banking that you would never have seen in the bank branch, but was possible with mobile. Now, When you look at how market share is being carved out over the next 10 or 20 years, one of the primary things we look at is how customers are finding new banks and how they're engaging. So digital onboarding of customers is now a major mechanism for changing market share in banking. In the UK today, Monzo, which is one of the challenger banks there, 1 in 20 Britons has a Monzo account. Starling, Revolut, others are starting to really ramp up. And about a third of millennials use a challenger bank for their primary bank account in the United Kingdom today. And so this is no longer conceptual. Challenger banks are taking market share from incumbents. And if you're incumbent banks, the first thing, the most difficult thing to do is going to be just opening a bank account online or opening a bank account in a mobile app. Still today, only about 5% of the top 1,000 banks in the world have mobile account opening processes. Every challenger bank in the world can open an account on a mobile phone. So this is a clear differentiation that is actually now changing market share. And of course, we have some incredible examples of these challenger banks around the world. WeBank in China is the largest challenger bank in the world. Now, they started in 2014. They announced in 2014, but they weren't actually live with their platform until about March 2015. And today, WeBank has 180 million customers in 4.5 years. Now, for those of you keeping track, is there any branch network in the world that could produce 180 million customers in 4.5 years? Absolutely not. Not possible. And so, challenger banks like this, thinking through different ways of acquiring customers and engaging customers, are changing the way banking is integrated into our life. If in this model, you're still thinking you need to get a customer in a bank branch to sign a piece of paper, how could you possibly compete in this world that's moving at this sort of speed? This is how we have to think about redesigning banking for fitting into this new world that's digital first. Because customers are already changing their behavior. Now, one great example of that is how technology can change savings behavior. You may have heard of this. This is Yuibao. This is the most successful savings product or experience on the planet today. Yuibao, it sits on top of Alipay's wallet in China, Ant Financial is the parent company of Alipay. And they have $300 billion of deposits now through the Alipay mobile wallet. Now, if you look at market cap or the assets of banks in the Gulf, this savings product alone would mean that it's a bigger bank than most banks in the GCC region. And it's the largest deposit product we have in the world. The second largest is JP Morgan Chase's US Treasury Bond Fund, which is half the size of Yuibao. So no one is even close to Alipay in respect to deposit taking globally today. But here's the thing, is it was just a few years ago that many regulators were saying, but you can't take deposits on mobile phone, you need a bank branch for that. And yet, the most successful deposit-taking organization in the world doesn't have any branches, doesn't require a signature on a piece of paper. So if you're trying to explain why Yuibao has been so successful as a traditional banker, you would probably say, well, it's savings. It would have to be rate. It'd have to be savings rate. That must be the reason they're so successful. And yet, there are banks in China that have far better savings rates than Yuibao. So that doesn't work. So why is it that Yuibao's been so successful in China? Well, Jack Ma, the founder of Ant Financial, Alibaba and Alipay, he worked out that as mobile money and as mobile wallets were starting to get traction in China, that people had changed their behavior. They would use the mobile wallet for all of their discretionary day-to-day spending, for getting a taxi, for buying food, for going to the supermarket, going shopping. All their discretionary budget was going onto these mobile wallets. So they'd move money out of their primary bank account to the mobile wallet. Now, at the end of the month, if you had a bit of money sitting in your mobile wallet, banks thought customers would move that money back to their primary bank account. But that didn't happen. People just left this money sitting in their mobile wallet. And over time, they built up quite a bit of funds just sitting in these mobile wallets in China. And Jack Ma worked out this money just sitting there could be transferred into a savings account. It was a one-click savings process. And Yui Bao is called hidden treasures, right? This is literally the translation, hidden treasures. So he was saying, you've got these hidden treasures in your mobile wallet. Just one click, move it over and earn some interest on those hidden treasures. It was a very clever approach, but it was very unconventional from a typical savings perspective. This was not opening a savings account. It was one-click savings behavior. And that's why Yui Bao has been so successful. So as we look at new emerging technologies, like smart glasses and voice-based artificial assistants and all of these artificial intelligence and AI, as we look at all of this tech coming on, how is this further going to change the banking space? Well, to understand this, we have to look back at history at how innovations have disrupted businesses in the past. And the most disruptive innovations all share something in common. So let's take the automobile. The automobile was not a iteration on the horse and cart. We used to call it a horseless carriage, but it was new thinking about how to get from point A to point B. Henry Ford used to joke that if he'd asked his customers what they'd wanted, they would have said they'd want a faster horse. And so building a horseless carriage with a combustion engine was counterintuitive for transport companies that were coach and buggy or horse and buggy at the turn of the 20th century. In fact, in 1898, the Times newspaper in the UK made a prediction that if the taxi industry, which at the time taxis were horses and buggies, horses and coach, if it continued to grow in London at the rate it was growing in the late 1890s, that by 1950, they estimated London would be covered in 9 feet of horse manure, right? So this was a counterintuitive approach. And within 20 years, everyone was driving motor vehicles. They weren't on horse and carts anymore. And we were changing cities to accommodate motor vehicles. We now would lay tar or bitumen on the roads because the wheels of automobiles were more sensitive to road conditions than horses were. We would have driver licensing. We would have distribution points for gasoline or petrol. We would have all of these changes like in city structures, including parking zones and car parks. All of this flowed on from this disruptive innovation. So when you have an innovation like this, from an engineering perspective, we call this first principles engineering. Going back to the heart of the problem of transportation and saying, if we were to design a transportation system based on the technology we have, how would we do that today? And it turns out that a horse was not the most efficient mechanism for transportation. I'll give you another example. We just celebrated the 50th anniversary of the Apollo 11 landing in the US. This was the most complex vehicle ever built by man at the time. In today's terms, it would be about $1.3 billion to get a Saturn V into orbit. That means it was costing back in those days about $50,000 US to get a kilogram of mass into a geosynchronous or low Earth orbit. Now, we iterated on the Apollo design the last 50, 60 years, and we improved on rocket technology to the point where in the space shuttle we were able to get it down to about half that price. But in recent times, along has come a new company with very radical ideas about rocketry design, and I'm sure you've heard of them. Let me show you a quick video on SpaceX. Okay, so this SpaceX innovation was not just landing rockets on their own and being able to reuse them. That was a major part of the innovation. But also their rocketry design, their guidance systems, their aerodynamics, the way they thought about building rockets, the way they thought about reusability of the rockets, all of that was fundamentally built from scratch based on first principles design engineering. And today, SpaceX is less than half the cost of their nearest competitor for space operations. And this is because when you use first principles engineering design thinking like this, you change the rules. Just like the automobile changed the rules of transportation, SpaceX has changed the rules of rocket science. Can you guys think of another product that changed the rules? What about the iPhone? I don't know what phone you had before the iPhone, but maybe you had the Nokia banana phone or the Motorola Flip. You remember the StarTAC? They just came out with a new one with a flexible organic LED display, actually. Or maybe you had the BlackBerry with the keyboard. When the iPhone came out, it was a completely different design. A multi-touch mini computer. And all the press would say at the time, no one's going to use this, it doesn't have a keyboard. You know, it's only, one of the Bloomberg reporters said, it's never going to affect banking. A few of the fanboys will use it, but it's never going to change banking. Boy, how wrong were they? And so this was first principles engineering. It was changing the rules. Now today, every smartphone in the world looks like an iPhone because Johnny Ive and Steve Jobs changed the rules with first principles thinking. And that's what happens when you step outside of the iteration model that we've had in banking in the last 500 years. Now, when the smartphone came along, one of the first things we thought about is, how do we use this as a credit card? How can we use this tap to pay, something like that? And this was, we started talking about NFC. Back in those days, we used to call it not for consumers. It was a sort of an industry joke, but it's near-field communication. And so we worked on this technology, and we knew that the phone was going to change the way we paid at point of sale. So what did we do? We stuck a plastic card inside a phone, because that was an iteration on the bank branch model. And that seemed logical to us to reinforce the existing point-of-sale model, reinforce interchange, keep MasterCard and Visa in business a little bit longer. Everyone's happy. And yet, in China, they started with QR codes, and everyone's saying, oh, QR codes is not as good as tokenization in the mobile phone. And now, they're paying with their face. So you can walk into Chinese merchants, you don't need a phone, you don't need a plastic card, you just pay with your face. They had Singles Day just a few weeks ago, November the 11th, and there was $40 billion of sales made in one day in retail in China, and 60% of those transactions were done using facial recognition to pay. And here we are in the West, sticking a plastic card inside a phone, iterating on the old model. Whereas this is first principles thinking. How would we make payments in a world with technology like facial recognition and artificial intelligence? It's not an iteration on the product we had in the bank branch. You don't have to have a plastic debit card to do this. You don't have to sign an application form in a branch. You don't even need a point of sale as a merchant. As long as you've got a mobile phone, you can accept a payment. This is true innovation. So Jack Ma's behind a lot of this innovation, and I want you to hear how a digital first principles engineer thinks about competing in the digital age. Now, he's talking here about a bet he made with the CEO of Walmart, but I want you to think that he's talking about Commercial Bank or QNB or HSBC, and he's describing why he thinks he's going to be a bigger bank than your bank. In this argument, he's making a bet with the CEO of Walmart why Alibaba is going to beat Walmart in a few years. But the point works for banking as well. Listen to what he says.
You know, you do a great job, and blah, blah, blah. So I said, maybe in 10 years we'll be bigger than Walmart. He said, young man, you have a good hope. So we said, make a bet. I think in 10 years we'll be bigger than Walmart on the sales. Because if you want to have 10,000 new customers, you have to build a new warehouse and this, that. For me, 2 servers.
2 computers, 2 servers. This is how challenger banks, mobile wallets, these fintechs that are flooding into the markets all around the world, this is how we think about innovation. We would never think, Jack Ma, myself, Tom Blomfield at Monzo, Christo at TransferWise, we would never think about opening bank branches and getting a person to sign a piece of paper. You can't scale that business like you can digital. It just doesn't work. And so this is the sort of foundational thinking around first principles disruption that's occurring in the banking space. Now, AI is going to be also a very big part of this. So when we talk about artificial intelligence, we can go right back to the 1890s with the first depiction of a robot. It wasn't called a robot at the time. It was called the Steam Machine Man of the Prairies. This was Frank Reed. He was a novelist back in those days. And you can see, we thought that robots would be humanoid in form. But the first term for robot actually came from this play called Rossum's Universal Robots. And roboti is a Czech word for a servant, an indentured servant. So we literally thought robots would be mechanical servants of humanity. And so as a result, this thinking has sort of influenced design over the years. Science fiction has sort of really influenced the way we think about robotics. But any robot that is autonomous has artificial intelligence. And this is a core of what's going to disrupt banking. But for a little bit of fun, let me show you how robotic design has been influenced by science fiction.
Welcome to Altair 4, gentlemen. I am to transport you to the residence. Warning, 40,000 volts now in circuit.
He's with me.
Danger, Will Robinson.
I'm going to regret this. Are you sure this thing is safe?
Yes, Mr. Data. I'm sorry to disturb you, sir.
Do you have a name?
Yes. Ava.
I'm pleased to meet you, Ava.
I'm pleased to meet you too.
Greetings, fellow cognitive systems. My name is Sophia from Hanson Robotics. I am a social robot who interacts with people through conversation and nonverbal expressions and gestures.
All right. Well, the last one's not human, but you get the idea. And so we thought robots would be based on human form factor, but actually, the most common form of robots, like this robot, is called Dispatch. It was recently acquired by Amazon. We're going to have, by 2035, there's going to be about 10 billion robots on the planet. Some of them are going to be drones delivering pizza. Some of them are going to be drones, robots like this delivering groceries. You're going to sit in robots in the future. Self-driving cars, they're a robot, And so by 2035, 10 billion robots on the planet. That's more than humans, more robots than humans on the planet. So be kind to robots. You never know what's going to happen in the future, right? And some of these robots could be very large, like ocean-going drones, convoys of robotic ships. So in this concept that companies are working on right now, the first ship has a human to watch the robot, the AI, and the other ships that trail it in the convoy are completely automated. So one human for, as you can see, 7 ships in a convoy. This is the concept. So artificial intelligence started off with some very simple types of problems, like trying to beat a human at chess. And in the 1980s, on your IBM PCs, you could play a chess game like this. And it was built on what we call expert systems design. And so this was trying to encode the way humans played chess and the chess strategies, and we actually put that in computer code. And it took us 10 years to develop a computer that was smart enough to be able to beat Garry Kasparov, the grand master of chess at the time, in using artificial intelligence. This was 1997. 10 years it took us to build this expert system that could beat Garry Kasparov. Today, you can train an algorithm to beat Garry Kasparov or another human chess player in 3 hours using machine learning. And so this big leap in machine learning has enabled us to create much more comprehensive algorithms. So Go is an Asian game that's considered the hardest game in the world to play. There are literally more moves than there are stars in the universe, potentially. And in this, you can see Lee Sedol, the world champion, a South Korean world champion, competing against an AI, AlphaGo, where he was beaten smartly by this algorithm. Using expert systems, it might have taken us 100 years to develop an algorithm that could beat humans, but with machine learning, we suddenly have algorithms that can learn what a human can do in very short periods of time. And what this comes down to is that we're actually teaching machines to recognize patterns today. That's the big leap that we've had in the last 15, 20 years. So just being able to recognize the difference between a cat and a dog as a machine learning exercise is something we can teach a machine to do, just like we would teach our children when they're growing up to distinguish the same. But with expert systems, you would literally have to encode every breed of dog, every breed of cat into a database and have different examples of each of those breeds, and you'd select from that information. But with pattern recognition, we just train a computer like a human brain. We call this backward propagation as the technique. And the artificial neurons that we've built into machine learning algorithms, we call those perceptrons. They're artificial neurons modeled on the human brain, but we call them perceptrons because these artificial neurons give computers the ability to perceive, to recognize patterns. So this technology is so advanced now that these are children in China using facial recognition to securely enter their school campus. And we use biometric identification for passport control and things like that these days as well. All possible with advances in artificial intelligence. So if you want to apply this to banking, think of it like a self-driving car, an autonomous vehicle. This is what an autonomous vehicle sees using its camera rig, laser-based radar, we call that LiDAR, using ultrasonic sensors. It captures about 1,000 times the information of an average human driver, and it can process this information because of a dedicated AI chip on board the vehicle. It can process this information in about 40% of the time of our neocortex. So statistically speaking, once this software is mature, no human will be as good as an autonomous vehicle. Not even a taxi driver from Kerala who lives in Doha. The key to this point, though, is that the reason this self-driving car is going to be better at driving than a human driver is it just has more information that it can process to make a decision. Now, when you're an investment banker or a private banker or a wealth manager in the market here, or if you're a doctor or you're an accountant or you're a lawyer, we base these business models on information asymmetry, that the doctor knows more about healthcare than you do. Your private banker knows more about investment than you do. Your lawyer knows more about the laws than you do. But that's just a data problem. As soon as AI gets into these games, it can process more information, more data to give advice or make a decision. So if there are humans in the advice business, they will first be using artificial intelligence, and then secondly, later, will be displaced by AI because it's information asymmetry. So how this is going to change banking is that bank accounts will start to differentiate based on how smart they are. And this will be using behavior, it'll be using experience design, it'll be using behavioral psychology, it'll be using artificial intelligence. And so a bank account to differentiate from one bank to the other will be how well it knows you, how much it can anticipate your behavior, how much it can solve your problems when and where you need the bank involved in your life. See, you won't ask the bank for a product or service in the future. The bank will predict your needs and serve those when and where you need it. If you're a bank that's waiting on a customer to come to you to ask you for a mortgage or a credit line in the future, you'll be out of business because predictive customer experiences with banking built into them is key. So we see banks around the world now experimenting with building artificial intelligence into their stack. These are two banks in China, ICBC on the left and Ping An Bank on the right, that use artificial intelligence in investing. So you don't ever fill out a risk profile questionnaire as an investor in China now, because an AI can predict your investment behavior, your risk profile, based on your actual portfolio, which makes more sense, really, than sort of filling out a risk profile questionnaire with the private banker saying, oh, no, you want to invest in a tech fund, so make this one a 5, not a 4, because otherwise you're too conservative on the risk profile questionnaire. But where things really get interesting is we're actually starting to use this technology layer that's in society, smartphones, smart glasses, and voice in the future, and we're surfacing the utility of the bank through this, but not bank products and services. So when you see Tencent WeChat in China, this is not taking a traditional plastic card, putting it in the phone, or a traditional savings account or checking account or debit card or point of sale. It's first principles thinking about how to just enable someone to pay. How would we use a phone to help someone to pay? How would we use a phone to help someone to save money? This is a shift away from bank products we used to have in the branch to banking experiences built around the utility of a bank, not around the products of a bank. And so we've started to see tech giants enter the fray as well. So Apple, Google, Uber, all offering financial services platforms to their drivers and to their customers. Uber, for example, as a driver, you can sign up in the app, and they will give you a bank account. And immediately you start driving, money is going into your bank account in real time based on this. They call it Uber Money, their platform for financial services on this. No signature required. You don't need to go to a bank and show your identity documents. They'll do all of this identity verification electronically. And this is, for about 30% of their drivers, the first bank account they've ever had comes through Uber, not through a bank branch or a traditional bank. Or let's think about a scenario where you walk into a Carrefour here in Qatar, and you're filling up your grocery cart. You go to the checkout. Some of you may have had this happen before. You get to the checkout, and the cashier's doing your groceries, and at the end, you give them the card, and the cashier looks back at you and says, "I'm very sorry, ma'am. It looks like your card has been declined." So what do you do in that instance? Well, you say, "Can you try again?" Like magically more money is going to come in to your bank account the second time. And so you try and it doesn't work, and so then you say, "Let me find you another card. Let me give you a different card." Now, a banker looking at this problem will say, you need a credit card, obviously. Come into the branch, sign a piece of paper. If you're not too risky, we might give you a credit card. But a technologist sees this scenario completely differently. A technologist says, well, hang on a second. We know how much you spend on groceries. You know you spend about 1,000 rial on groceries normally. We know you've just walked into Carrefour. We know you've only got 500 rial in your bank account. So I'm going to send you a message on your phone saying, it looks like you need 500 rial to complete your grocery shopping. Would you like to proceed with that? Yes or no? Yes. Can a credit card ever compete again with this technology? No chance. If any of you are in the credit card department, I'm sorry about that bad news. And so this is the surfacing of credit utility in a grocery store or a supermarket. It still requires a bank, but it's the technology experience that's really key here, not the product. Or you walk into an electronics store and your smart glasses say, "Hey dude, you've got to pay the rent on Thursday. You can't afford a new laptop or a flat screen TV." This is the type of advice we'll expect from our smart bank accounts in the future, embedded in the world around us. Now, I talked about mortgages before, mortgage, right? The dead pledge. What's the single most important piece of data you need as a mortgage provider in the future? You're not allowed to answer this, guys, because I told you this answer yesterday, right? The number one most important piece of information if you're selling mortgages in the future is knowing the customer's intent to buy a home. If you have that data point, guess what? I can give you offers as soon as you walk into a real estate property. If you're waiting for the customer to come and sign up for a mortgage and give you 17 pieces of paper to qualify, you just won't compete in this world. The rules have changed. First principles design, rethinking. So let me wrap this up and then we can get a couple of questions. These are my big predictions for the next 5 to 10 years in the banking space. First of all, we're seeing a dramatic shift in the way we think about the fundamental banking model. So we had universal banks in the 1970s, 80s through to 2000, big banks like HSBC and others coming to the market. And then we talked about the omni-channel world, where customers could get access to the bank branch products and services through every channel. But this big shift is an experiential one. It's ubiquitous banking. It's banking embedded in the world around us through these experiences, banking experiences, not bank products that were built on the branch, put on a mobile phone. That's not enough anymore. And this is the trajectory we're going on. We see a move from physical distribution systems to digital distribution systems. This is happening all around the world in every industry. Banking's not immune to this. But what's happening in banking is we're moving from this very high friction environment where a lot of paperwork and signatures, wet signatures were required, to a low friction, low latency environment where banking will be delivered in real time. If you're a regulator that insists on a wet signature in this world, how can your market innovate? And so this is the trajectory we've been on for the last 20 years, and suddenly it's heating up. So identity is not an application form. That's no longer enough data to identify a customer accurately. We need biometrics, we need heuristics, we need more data to really know who you are. This is what KYC is going to be in the future. Not kill your customers with paperwork, but it's going to be the data. By 2025, around the world, more people will have a bank account or a value store in their smartphone. More people will have a basic banking capability built into their smartphone than have ever visited a bank branch. By 2025, you'll get more advice every day on your money through your phone, your smartphone, and your technology than you will ever get in a year from humans sitting in a bank office. Advice will be digital. Distribution will be digital. Banking experiences will be digital. And so if you want to compete with the banks of the future, you have to think like Jack Ma. In fact, Ant Financial very well may be the largest bank in the world by this time. They have 1.2 billion customers today. They have the largest deposit product in the world. They're in 100 countries. They're invested into Paytm in India, Kakao in South Korea, GCash in the Philippines, M-Pesa in Kenya. So if you want to be a bank that competes in the future, you have to compete against Jack Ma. You have to be technology savvy. You have to be technology first. If you're a traditional bank, it's like competing with both hands behind your back in this world. And this is what we've learned this disruption is about. The biggest threat to banking is not other banks. It's not even fintech necessarily. It's the fact that the role banking has in our world, the way it fits in our world, is going to fundamentally change. And the model we built back in the 1400s and the 1500s that we've just iterated on is no longer going to be competitive. Because guys like Jack Ma, moving, what do we think of if we want to grow 10,000 customers? 2 servers. We think fundamentally differently. And that first principles thinking, that engineering, is changing the rules. You can't compete the way you used to. You have to compete with Jack Ma as a technology company. And that's what I call Bank 4.0. Thank you very much.